Hello everyone, Clifford Bennett, Chief Economist at ACY Securities. I'm feeling a little backed into the corner today as stocks continue to rally strongly. Very impressive again on Friday in New York as again tech sector earnings results kicked the market higher, but there was a lot of just kind of follow through buying or broad-based buying too. And I guess the main reason actually is this expectation and belief, and it could turn out to be correct, that the next Fed rate hike is going to be the last rate hike. So the market's gone, why wait for the last rate hike to happen, and just driving on up through that last rate hike expectation for this week. However, there's some aspects to the inflation data of late, as we've been highlighting, that mean perhaps it won't be quite that straightforward, and the market could end up being surprised that there are actually further interest rate hikes by the Federal Reserve. Now, that would happen if the reacceleration we've seen in services continues, or if the oil price were to again stabilize and move higher. It's had another fall. If to again stabilize, move higher, energy prices are very tight. One of the big LNG companies warned that there could be another price spike this coming season. So it's not all over, as the market likes to expect, on the inflation front. We know the US economy is in trouble. Every now and again there's a small bout of good data, but overall the trend is very much to the downside. Consumer spending looks to be in dire straits now, and we know that manufacturing is deeply underwater, as is the housing sector. So I would be expecting the Fed to definitely hike this meeting, but if they continue to see, and they put a lot of weight on it, I don't, but they put a lot of weight on the jobs data and the employment data, that could lead them to hike another 2 times, not another once. And if inflation were to reaccelerate, there'll be another 3 hikes. But for the moment, the market believes there's only going to be one more hike. It's about to happen, game over, and then they expect interest rate cuts, which of course just aren't going to happen. And a whole lot of economists, not just me, are warning there are not going to be no rate cuts. What are people in the market on about? It's wishful thinking, of course, right? Investors wanting to believe or believing what they want to believe. And you can apply that theory to a lot of things that are going on in the world at the moment. Speaking of a lot of strange things going on in the world, or unexpected things going on in the world, I suppose, for a long time I've been forecasting Trump will win the next election. I still believe he will. Not because I'm barracking for him necessarily. It's just how the numbers stack up, basically. 70% of voters don't think Biden should run, and 60% of voters think, this is from both sides of politics, holistically, 70% of voters polled did not think Biden should run again, and 60% of voters polled thought 30% of voters polled thought Trump should not run again. And the reverse was pretty much the same. So there's a lot of reasons for saying, without having a political bias, that Trump's going to win the next presidential election. Now, the interesting part is Kennedy throwing his hat into the ring. So Senator Kennedy has said he's going to run for pre-selection, for nomination for the President of the United States, and that's a very historic event. Whether he has the numbers or not remains to be seen. He probably doesn't have the numbers. He probably is the better person for the job, but he probably doesn't have the numbers. But nevertheless, it's something to keep in the back of your mind that it could be a Kennedy-Trump runoff. And in that situation, I think it would be incredibly tight indeed, and a very difficult one to call. I'd probably still say Trump, but a lot harder to predict in that runoff. So a lot narrower margin, but I'd still tilt towards Trump. Over in Australia, we have the Reserve Bank meeting tomorrow, and they're likely to stay on hold because there's enough evidence now that they can say, look, it's nice to see some stabilization in the housing market, but the gains seen, just released today, CoreLogic, 0.1 here, 0.1 there, they're in the small numbers compared to the big numbers that we saw in the decline. We actually had the fastest decline in Australian property markets in history over the last 12 to 18 months. So there have been bigger declines, but not as fast. So some stabilization is good, But the stabilization is predicated on the idea that the RBA will not be hiking rates ever again. And that's probably wrong, because the new normal is current rates or higher. The RBA is pausing. The RBA has just been reviewed. It's been, found in the review that it should be conducting deeper consideration of economic factors. In other words, you idiots, what have you been doing? It really is what it says. As much as everyone wants to be diplomatic and tiptoe around it, that's basically the conclusion. So there'll be an expert panel taking over monetary policy in a couple of months, taking away from the governor of the RBA, because the governors of the RBA, since really the GFC, haven't done a very good job. So that's all well and good. But because of this review and its findings, the RBA at this meeting, having been wrapped over the knuckles, but pretending they haven't been, is certainly going to lean on the side of caution in deciding monetary policy at this meeting. And in any case, it would be a bad look to pause for one meeting and start again without the data being dramatic. And they don't have dramatic enough, although we have clear signs of firm to stronger inflation coming through, perhaps, but we don't have the dramatic uptick in inflation that require the RBA to immediately go from on hold to hiking again. So I think they will be on hold, and also they will allude significantly to global uncertainties, which are there. And particularly with China's manufacturing PMI moving back into contraction over the weekend. So where's that post-COVID boom? It looks like it's already happened. It's over. Except, of course, for consumers and travel, because that still seems to be doing reasonably well. Nevertheless, retail sales really sank again. This is something, if you've been following me, I've been saying for the last 2 years, China was never going to return post-COVID. Remember all those post-COVID, China will take off. And I said, no, it won't. Its long-term growth trajectory is now 2 to 5% rather than 5 to 10. Okay, it might have a 1 year of a 6% sort of print, but overall it's really around 5 or lower that China is going to track. And as the world's second largest economy, that's amazing. So the Chinese miracle is ongoing, but it's ongoing from a much larger base. Hence, the percentage gains have to come down. From big swathes of China, it's a maturing capitalist consumer economy. For some swathes of China, it still has growth potential. That's why growth's going to stay high. But it is getting closer to really being, you should expect it to track more closely to Western-style GDP numbers, but not as badly as Western economic GDP numbers. The United States and Europe are still in dire straits, despite how excited people like to get about, 1 month was better than the last, or the last 6 months. Yes, but they're all at catastrophic levels. So the global economy is going to continue to slow, and that manufacturing data and retail sales in China really does confirm that China won't be giving the huge uptick to the global economy that many hope for. It'll give some upward pressure. It'll give some support. Remember, it was China that stabilized the global economy in the GFC, and it will continue to add significantly to global growth. But China's overall growth and that global growth are both going to be on lower trajectories. For the moment, stocks all excited. Let's have a party. It's the last rate hike. It may not be, but that's what the market believes for now. That being said, perhaps there will be some buy the rumor, sell the fact. In other words, it's going to be the last rate hike. Buy the rumor, buy the rumor, buy the rumor. And then it's a case of sell the fact after the event. So I'd be a little bit wary of that, particularly also as, yes, there are some good earnings, but there are some bad earnings coming out too. And the outlook for earnings is not great, again, going forward into the second, third, fourth quarters, first quarter, second quarter of next year. This is not a strong outlook for corporate earnings over this period. So I think there is, like I always am, aren't I, suggesting that there could be a top in equities. And a lot of times I've been right, and sometimes I've been wrong. But I do think the market is overly extended, huge jumps on really modestly better than worst case for earnings shouldn't be something that people have been so very excited about over the past week. So therefore, I think I kind of missed the opportunity to understand that it was more about the expectation of the last rate hike coming very, very soon indeed to a screen near you. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.